Every investor has a risk personality, and yours is either making you money or quietly bleeding you dry. Whether you're the type to bet big on a duplex in a war zone, or the type who triple checks flood maps before signing anything, there's one rule that applies to every single one of you. Insurance isn't optional. It's the foundation that keeps your entire portfolio from collapsing on a Tuesday afternoon when a tenant slips on a wet floor and calls their cousin the attorney. We're talking about the difference between a minor inconvenience and a lawsuit that wipes out 5 years of equity in one court date. Let's break down where most investors sit on this spectrum. Because the risk tolerance conversation is more nuanced than just aggressive or conservative. Think of it like a dial. On one end, you've got the adrenaline junkies flipping in hurricane, corridors. And on the other end, you've got the spreadsheet philosophers who won't close unless every scenario is modeled out to the third decimal. Most of you are somewhere in the middle. And that's actually where the most dangerous blind spots live. You're careful enough to feel protected, but not thorough enough to actually be protected. And that gap is exactly where financial disasters are born. Now here's where the story gets interesting, because the real estate world has sold a very seductive narrative for decades. Buy the asset, build the equity, collect the rent, repeat. What gets glossed over in that pitch is the catastrophic cost of a single uninsured event derailing the entire machine. General liability insurance is your first line of defense, and it covers you when someone gets injured on your property or when you're held responsible for damage you caused to someone else. Without it, one bad incident, one broken step, one falling tree limb, one contractor mishap becomes your entire net worth's problem. Hazard insurance is the one most people think they have figured out. And then a windstorm rolls through and they discover their policy had an exclusion they never read. Fire, flooding, hail, wind, these aren't rare freak events anymore. They're quarterly headlines. And the investors who treated their policy like a checkbox are the ones on the news looking stunned. Then there's contents insurance, which renters lean on, but landlords sometimes forget applies to them too. Your appliances, your fixtures, your personal assets tied to that property, those aren't automatically covered just because you own the building. And assuming otherwise is an expensive lesson you only want to learn once. Here's the part that rewires how you think about this. Insurance isn't a cost center, it's a risk transfer vehicle. You are literally paying a financially massive institution to absorb the catastrophic downside so you don't have to. And that is one of the most rational moves in the entire wealth building playbook. The historical pattern is painfully consistent. Investors who thrive over the long haul aren't always the smartest or the most aggressive. They're the ones who stayed in the game. And you can only stay in the game if you're not getting knocked out by an uninsured event in year 3 of a 30-year strategy. 30 plus years in this business, residential, commercial, markets hot and cold, and the investors who got hurt weren't usually the ones who picked the wrong property. They were the ones who were completely exposed when something went sideways because they treated protection like an afterthought instead of a prerequisite. The misconception that insurance is just for unlucky people is the kind of thinking that separates struggling investors from successful ones. Luck is just risk you didn't account for. And the disciplined investor accounts for everything before the deal closes, not after the damage is done. So the practical move here isn't complicated. Audit your current coverage, identify the gaps, and treat insurance as a non-negotiable line item in every single deal you underwrite. Position size matters, timing matters, but none of it matters if one lawsuit or one storm can erase the entire position. The philosophy is simple. You build wealth slowly and lose it fast. So your job is to eliminate the fast loss scenarios before they have a chance to find you. Discipline, consistency, and protection aren't the boring parts of investing. They're the parts that actually determine whether you're still investing 10 years from now. And if you want to find out what a bulletproof risk protection strategy could actually look like for your specific portfolio, check out the links in the description below. Whether you need help with real estate investing, home contracting work, or finding the right lenders, we're ready to help you get started.